The Federal Reserve has just concluded its most recent meeting, and the outcome is exactly what many were expecting. Yet the implications go far beyond a simple policy adjustment. The Fed officially cut interest rates and quietly set the stage for a major shift that could lead to massive money creation in the coming years. My estimate is that we're looking at trillions of dollars being injected into the system, potentially by 2026. That means renewed inflationary pressure is almost inevitable. Let's walk through what happened and why it matters. We'll start directly from the Fed's official FOMC statement. According to their release, the committee voted to lower the federal funds rate by 1/4 percentage point, bringing the target range to 4.0%. This move wasn't a surprise. Analysts, traders, and markets had largely priced it in. But the real story is in what followed. Alongside the rate cut, the Federal Reserve announced it will end its program of balance sheet reduction. In their words, the committee decided to conclude the reduction of its aggregate securities holdings on December 1st. In plain language, that means quantitative tightening. The process of shrinking the Fed's balance sheet is effectively over. Now think about the sequence here. First come the rate cuts. Then the tightening phase is brought to a close. What's next? Eventually, money printing resumes. I've been saying this since last year. Once they stop tightening, the next step is inevitable. And when that happens, inflation will come roaring back stronger than most people expect. The reason isn't mysterious. The Fed is trapped by its own policy constraints. It can't afford to keep tightening because doing so would crush credit markets and risk a deep recession. On the other hand, reversing course means fueling another wave of inflation. They're boxed in, and this meeting confirmed exactly that. Now let's look at the highlights from the press conference. The next Federal Reserve meeting is scheduled for December 10th, and one of the biggest questions heading into that event is whether another rate cut will happen. Before today's press conference, the CME FedWatch tool put the probability of another rate cut in December at roughly 92.8%. Reporters asked Chair Jerome Powell directly whether the market's assumption of another cut was justified. Nick Timiraos from the Wall Street Journal asked Powell if he was comfortable with the idea that a December rate cut had become a foregone conclusion. Powell responded carefully, saying that a further reduction in December is not a foregone conclusion. He emphasized that the committee has not made any decision yet, that opinions within the group are divided, and that there were strongly differing views among the 19 voting members. That means the December decision is still open for debate, something that caught the market's attention immediately. So why the disagreement inside the Fed? The main reason is that some officials believe the current rate level is close to where it should be. After several cuts this year, some committee members feel that monetary policy has already reached the so-called neutral rate, which is the point where interest rates neither stimulate nor slow down the economy. That neutral rate is often estimated between 3% and 4%, and Powell acknowledged that some within the committee think it may be even higher. He also reminded everyone that the neutral rate isn't something that can be directly measured. It's more of an estimate based on models and judgment. The conversation then turned to the Fed's constant reminder that its decisions are data-dependent. However, there's a new complication this time around. The ongoing government shutdown has delayed key economic reports, especially labor market data. Without that official data, the Fed's ability to make informed decisions is limited. Howard Schneider from Reuters asked Powell how this lack of information might impact the December decision. Powell responded that the Fed would still gather every scrap of data it can find, from private surveys, the Beige Book, and other non-governmental sources. Schneider pushed further, asking if this data blackout could make the Fed more cautious. Powell answered with an analogy. When you're driving in the fog, you slow down. In other words, when visibility is low, it makes sense to be more careful. So, yes, missing data could influence their pace and make the Fed less aggressive at the next meeting. Then Andrew Ackerman from The Washington Post followed up, asking whether this lack of data would make the committee more likely to stick to its September outlook or take a more cautious approach. Powell said that both sides of the argument would have merit. If the economy appears stable, some might argue that policy shouldn't change, while others will say it's too risky to act without solid data. Powell admitted he doesn't know how that debate will unfold, but he hopes the flow of government data will be restored before the December meeting. Next came a topic that's been dominating headlines: inflation. Reporters asked whether the Fed still views 2% as its official inflation target, and if that goal remains credible given current trends. Powell's answer was firm. He said, "We are absolutely committed to returning inflation to 2%. He added that both market pricing and longer-term expectations show that investors still believe the Fed's commitment is real. In other words, the Fed wants to reassure the public that it hasn't abandoned its mandate, even though inflation remains elevated. Then a reporter asked about the impact of tariffs, which have been driving up certain prices across the supply chain. Powell acknowledged that tariffs are contributing to inflation, but argued that their effects should be temporary and moderate. He explained that as tariffs make their way through production and distribution channels, they cause a one-time increase in prices that eventually levels off. He estimated that inflation could rise by a few tenths of a percent as these effects filter through, but said that once all tariffs are fully implemented, they stop creating new inflationary pressure. Prices will stay higher, but the rate of increase should slow down, meaning measured inflation should settle back toward the non-tariff trend. Then came one of the biggest takeaways from the meeting: the Fed's balance sheet strategy. Powell stated that over the past 3.5 years, the Federal Reserve has reduced its securities holdings by roughly $2.2 trillion. As a share of nominal GDP, the balance sheet has dropped from around 35% to about 21%. Starting in December, the Fed will shift into what Powell called the next phase of normalization. Instead of continuing to shrink the balance sheet, they'll hold it steady for a time. Now that phrase, "for a time," is deliberately vague. Powell didn't define how long this pause will last, and that's intentional. In my view, and in the view of many analysts, this means the Fed is effectively waiting for something to break in the financial system. Once there's a major liquidity event or a credit disruption, they'll restart asset purchases. In other words, money printing. It's the same playbook we've seen time and again. They withdraw liquidity until markets strain, then they intervene to stabilize things. Finally, Powell addressed the public's frustration with the current economic environment. He acknowledged that consumers are unhappy about inflation, and that even though price growth has slowed, people still feel the lingering effects of the massive price jumps from 2021 through 2023. He said that while inflation isn't rising as fast as it was, the prices themselves are still much higher than they used to be, and that's why people are dissatisfied. Powell added that over time, as wages and real incomes rise, consumers will start to feel some relief, but that process will take time. In other words, don't expect an immediate improvement in how inflation feels at the household level. When you piece this all together, it paints a very clear picture. The Fed has officially entered a transition phase. Rate cuts have begun. Quantitative tightening is ending. The next logical step, whenever the next market or credit stress appears, will be a return to money creation. Whether that happens in 2026 or sooner depends on how resilient the financial system proves to be. For now, the Fed's official message is that everything is under control, that inflation is moving in the right direction, that the economy remains stable, and that their policies are data-driven. But behind that calm exterior, the reality is that they're running out of room to maneuver. With rates falling and balance sheet reductions paused, the central bank's ability to fight inflation without triggering instability is narrowing fast. These moves mark the early stages of what could become the next major monetary pivot, one that sets the stage for a new inflation cycle. It's the same pattern we've seen repeatedly over the past 2 decades. Tightening, followed by easing, followed by an eventual flood of liquidity. And every time, it's been followed by a wave of asset inflation, then consumer inflation, and finally renewed calls for tightening. That's the full context of this Fed meeting and press conference. It's a pivotal moment, and whether you're following markets, investing, or just trying to understand what comes next for the economy, it's worth paying attention to every word the Fed says from here. Because once this pause transitions into the next round of easing, The consequences for inflation, the dollar, and the broader financial system will be enormous. Those are the major highlights from the Federal Reserve's latest meeting and press conference. If you found this breakdown useful, make sure to stay tuned. I'll continue tracking these developments closely. Thank you for the support. I appreciate it, and I hope you have a great day.